Let's talk about the Black Litterman model. You should have two spreadsheets on the Desire to Learn, Black Litterman and also ETF March 29. We'll start with Black Litterman. This was developed by Fisher Black and Robert Litterman at Goldman Sachs. We're not going to do the full model, but we're going to do a good portion of it. This portion right here is not on your the file on Desire to Learn, but these are the steps. So what we're going to do is we're going to say these 10 stocks right here are the only 10 assets in the economy. The first thing that we do is we find their historical covariance matrix. So going over here to the returns, let's find the historical covariance matrix as you've done before. The next thing we want to do is look up the market weights. This is the market capitalization of each one of them. And the idea behind the Black Litterman is this. The market is right except when it's wrong. So let's use the market as a starting point. So I can look and see that the market has 10.19% of its money in Coke, 0.71 in Eastman Kodak, 39.36 in GE, and so forth. So this is, if markets are perfectly efficient, this is the optimal risky portfolio right here. It's already given for us. And what Black and Litterman said, look, let's back out the implied returns, because what did we need to come up with the optimal risky portfolio we've already done in class? We needed the returns and the weights. So what these guys said, let's use the weights of the optimal risky portfolio as defined by what the market believes it is. And I'm going to deliver value to my client by coming up with better weights. Okay, so how do I do that? Well, what I want to do is come up with the returns the market must believe. So the market must have used these returns and this covariance matrix in order to come up with these weights. Okay, so the first thing we need to do is back out these implied returns. Here's how that's done. That's the matrix multiplication we need to do that. This is for a 10 by 10. I want you to be able to do it for 5 by 5, 7 by 7, however many assets that I decide to give you. Okay, this is the historical return. So if I just went and did historical returns, found historical weights like you did before. But look at the obvious flaws in this. I have all these negative weights. Basically what I'm doing if I use the historical approach is I'm putting all my money in Bank of America. Look, I mean, it's 94%, right? So rather than assuming these returns, which is what they were, assume these returns, which is what the market believes they will be. So the first thing to do is to back those out. Step number 2, just as a check, now using these returns and this covariance matrix, see if you can find these weights. These weights should match these weights. I just want you to do that as a check to see that you're doing the matrix algebra correctly. Now here's where the genius of it comes in. Here's what's really valuable. Black and Litterman say, look, I can be an expert in certain stocks, certain asset classes, or whatever. I can't be an expert in all of them. So what I'm going to do, I'm going to look at what I know. I'll look at Coca-Cola. The market says they're getting a return of 1.63%. That's what the market expects for next year. And by the way, I'm just randomly picking 10 stocks, so this is a little bit unrealistic, but it gets you through the math perfectly. So the market is assuming a 1.63% return on Coke for next year. I think it's going to be higher than that. I think it's going to be 2 basis points higher. So I put in a 2 right here, and the 2, look what I have. The 2 plus the 1.63 is going to be my returns of 3.63. So because I added those returns, it increased my weights. Now look, my weight is 10% in Coke, but when I increase that return, it goes to 2%. I mean, it goes to 34.8%. But another thing that happened is this. If I know something about the returns of Coke, do I know anything about the returns of the other stocks? I'm a Coke expert. I'm an Eastman Kodak expert. I'm going to say Eastman Kodak is going to have higher returns, 1% higher. Everything else, I don't know anything about these other companies. No clue, no analyst covering those at all. Does my knowledge of how Coke and Eastman Kodak perform inform me anything about how these other guys will perform? The answer is yes, because I have what? I have the covariance matrix here. This covariance matrix is the relationship of Coke and Eastman Kodak to these other stocks. So what I do for the Black Litterman model is I take the returns the market believes, I adjust the two stocks or whatever assets I know about, and my adjustments of those assets therefore adjust the others because I know their relationship, which goes through this covariance matrix. That then gives me my opinion adjusted weights. So now, in my opinion, if I'm right, then the weights should be 34% Coke, not 10, 3% Eastman Kodak, not 0.7, 31 GE, not 39, and so forth. The next thing says, well, hang on just a second. Are you sure? Well, and I'll talk more about this in class. I can't be 100% sure I'm right. I think I'm right, so I'm going to give some confidence level. I'm 70% sure I'm right and the market's wrong. And that's a huge statement to say I'm right and the market's wrong. So I'm 70% sure I'm right and the market's wrong. So my final weights look like this. So I'm somewhere in between my beliefs, the opinion adjusted weights, and the market's beliefs, the implied weights. This is my final model portfolio. These are the investments I actually make. Now notice a couple of things that depends on. I'll come up with these returns. Right here it depends on the benchmark. This is what I think the market return will be and the risk-free rate. So basically the benchmark return minus the risk-free rate, that is my market risk premium or my benchmark risk premium. And then, by the way, these, I don't know where this came from. Clear that off. And these are the tracking factors, which is the best explanation. This is going to give me the relationship of the changes. So if I think Coke is going to increase, how do the other stocks change? It goes through this tracking factors matrix. So what I want you to do basically is reverse engineer the spreadsheet. Okay, so kind of here's the final thing about it. for this spreadsheet, I want you to build this spreadsheet. Actually, I want you to just look at this one, see where everything came from, and kind of understand it. This is given. I'll look up the market capitalizations. Look that up on Yahoo. I did this maybe a year or so ago, and therefore that is the weight of each of those 10 stocks, and these are the only 10 stocks in the world. This is the covariance matrix that you know how to build. This is what I expect the market return to be. This is the risk-free rate, so the difference is a market risk premium. Just for fun, come up with the historical returns just by taking the average of these over here. These are the historical returns. Using the historical returns and the covariance matrix, come up with the historical weights. That's what we've already done, and look how wild they are, how far off they are. This is the problem that Black and Litterman wanted to address. And what they did is said, look, instead of taking the returns in the covariance matrix and finding the weights, take the weights in the covariance matrix and find the returns. And we're assuming that the market weights are the optimal risky portfolio as the market believes it to be. So here are the returns the market is predicting. I know more than the market about Coke and Eastman Kodak. I don't know anything about the others, so I put my opinion in about Coke and Eastman Kodak, and that's going to change my opinion about the returns of the other stocks. So here's what I believe the returns are going to be. So using the returns that I believe, the returns that I believe right here, with the covariance matrix that I've calculated, I find my weights. This is my optimal risky portfolio. But then I think to myself, hang on just a second, I'm different than the market. If I'm different than the market, am I sure I'm right? Well, no, I'm not sure I'm right. I'm pretty sure I'm right. I'm 70% sure I'm right. So the actual weights I use is 70% of what I believe plus 30% of what the market believes. Okay, now that you've got that, look at this ETF. This is going to be a little more realistic. This is the returns for these different ETFs, sector ETFs, real data. This is the actual percentage weight of each one of them. Now I want to do the Black Litterman model, so I want to take this data and put it into the Black Litterman spreadsheet and allow myself to put in my opinions about certain ones of those stocks. So I'm an expert in these sectors right here. I don't know anything about those sectors right there. So the ones in yellow I know about, the ones in blue I don't. See if you can reverse engineer that spreadsheet, and we'll discuss more in class.